So we look at the actual expense line items, so every single line, insurance, rent, utilities, vans, everything. Can we get a better deal? Yes, that's a good exercise to do.
If you keep cutting, sometimes you're cutting something that was very, very valuable, that was actually a major part of generating that top line.
Yeah. So you've got all of your assets, which are the things that you own. You've got your liabilities, which is what you owe to other people. And then you've got your equity, which is what's left.
What's the biggest financial mistake that you see business owners making time and again?
Well, we go and find the part that isn't working, and then we focus on fixing that part and that part only. We wouldn't bother trying to fix the parts that are working, because that would be madness. Yeah. So because we're not going to get very far.
Exactly. Yeah.
I was a finance person. Business owners were experts at what they did, but they were not numbers people. But it was never really our money in the first place. We've got 100 grand in cash, and we don't owe that to HMRC until September. And I'm like, hold on a second. That's not your cash. We're just tax collectors for the government, basically.
So what's one simple change that a business could make to improve its cash flow? So Tom, thank you very much for coming on working on it. I appreciate you coming down. Thank you. So Tom, what do you think is the biggest financial misunderstanding business owners make?
Yeah, so firstly, thanks very, very much, Brad, for having me. It's a pleasure to be here.
No problem.
Diving straight into it then.
Yes.
Financial mistakes that business owners make.
Yeah.
I think it comes down to not doing the basics, which in my opinion is tracking the numbers and using the numbers to make data-driven decisions. Very easily, it's very easy to get into the trap as business owners of making decisions based on how much money's in the bank account or based on gut, and forgetting that we have upcoming liabilities that we need to pay to HMRC, and then all of a sudden you make a decision based off the amount of money in the bank account, and then you spend the money you owe to HMRC, and then you're in a cash flow crisis a few months later. So I think it comes back to the basics: track the numbers, get on top of your cash flow, get a clear picture of what's coming in and out of the business on a few months out basis. Beyond that, it's kind of a bit of guesswork anyway, as you can, I'm sure, relate to.
Yeah.
And then from there, it means that you've got a bit more clarity to work with, and you can make decisions with a bit more foresight of what's coming next.
Yeah, I suppose it's all like forecasting, isn't it? And like you say, tracking the numbers and so on, even just looking at what's gone past, but also what's coming up, equally as important, isn't it, really? And I think that's probably a trap that a lot of people fall into. And like you say, if you've had a good month or a good week even, or a good remittance come in, you think, I've paid everything, I'm done.
Yeah.
Okay, I'm going to spend the rest of it on a holiday or so, whatever it is, all of a sudden something else pops up. You don't think about that future part, do you, really? Which I think is a trap that we all fall in at some point. So JPMorgan, so you work there. What do you think made you switch from sort of like that massive corporate world into something that you think you could maybe be able to offer SMEs? Like what gap did you see that you think, do you know what, I could help out there?
Good question. So my background, so I spent 7 years at JPMorgan, 4 years in the corporate investment bank, and then 3 years in asset management. And I did a few different roles there. But during COVID, I basically came to the realization that I wanted to do a few other things in my life. I wanted my work to be a bit more entrepreneurial, have a bit more control of who I worked with and what I actually did on a daily basis. At JPMorgan, any big company really, you're kind of a small cog in a big machine. Your day-to-day role is often actually quite limited in terms of what you're doing. And I just wanted it to be a bit broader and, like I said, a bit more entrepreneurial, creative. And so I decided that I was going to leave. And initially, I didn't really know what I was going to do next. But over time, I started doing a bit of consulting to small business owners. So bits of mergers and acquisitions. Someone was looking to buy another business. Another one was looking to sell. So I helped them get ready for sale from a financial perspective. Another one was doing a bit of fundraising. So I helped them put the model together, the deck, all that stuff. And what I realized in that process was that the business owners that I was working with, so small businesses, sub 20 million in revenue, they were really good at what they did. They were experts at what they did. So if you imagine a builder is a builder, they're an expert builder, they start a construction business. A dentist is a dentist, they start a dental practice. But in that transition from being the expert at what you do, you're expert in your trade, into being a business owner, you inadvertently have to learn all these other things. So that builder has to learn how to do sales and marketing, otherwise they're not going to have any anything to build.
Yeah,
In my case,
yeah.
I was a finance person, so I left thinking, oh great, I'm going to go help small businesses with their finances, or and then I realized, hold on a second, if I don't learn how to market and sell, then I'm not going to have anyone to help with their finances.
Yeah.
So what I realized in that process, like I said, was that these business owners were experts at what they did, but they were not numbers people, and they weren't on top of their numbers in a way that I took for granted and assumed that everybody was because of my background in finance. So I realized that actually, if I could put together a process and support business owners on a monthly basis where I help them understand how the business is performing, help them paint a picture using that information of what's working and what's not working in the business, and then help them use that information, that insight, to drive decision making so that they're not guessing based on how much money is in the bank account, and they're not using their gut to decide what to do next, and they're not spending their VAT liability on going on a holiday, like you said. Then if the few number of businesses that I was helping at that time was symptomatic of the larger, the wider economy of small business owners, then there are going to be a lot of business owners that I can help. And so that's what I have been doing since then.
That's brilliant, because like I've told this story several times, but when I first started out, I did fall into that trap, and I did spend the VAT liability. But what I'd done was, it was before all the cloud-based software was available. So my data was on a hard drive that was in Brixton in South London, that was like, 30 minutes away from me, for another accountant I was using. And he wasn't quite up to date with everything. So then it was only when I got a business coach in, and he said, look, you need to check your numbers. And I didn't understand any of this at the time. And I then thought, okay, right, let me go and get my hard drive from my accountant. It wasn't like a proper account. It was like someone done it on the side. And then I then got my hard drive, bought it back. And he then said, look, Brad, you owed HMRC like £95,000. And at the time, it was about 350 grand I was turning over in a year. And I did try and contact them saying, look, I'm going to pay you back, etc. They wanted it in 3 months. I was like, well, that's no chance. Like, no way going to happen. But that was a bit of a realization for me, of understanding your numbers, checking them, putting that bit aside, because you're collecting it. It's not really your money. You're collecting it on behalf of HMRC. So it's not really yours. And that was a massive turning point for me. And to have someone, so back then, obviously social media, website wasn't really, sort of internet wasn't really around. So it's almost like you didn't really have those consultancies that you do now, or that connection to information that you do now. And that was, that was a massive lesson for me. So you saying that, I'm like, you're literally just telling exactly what happened to me. So it's great that you've now got that set up,
Yeah, I think it's a really common idea that the cash that we collect from clients in VAT and the corporation tax is our money, but it was never really our money in the first place. We're just tax collectors for the government, basically. And so the number of times I've been in meetings with business owners who have said, it's okay, we've got 100 grand in cash and we don't owe that to HMRC until September. And I'm like, hold on a second, that's not your cash. So if you spend that now, or you use it to support your operations, you're going to have to find that again by September. So I think a good practice for any business owner really is, as soon as you collect that money, the VAT and the corporation tax, you put it aside immediately. You can have one account for corporation tax and one account for VAT. And I think that can save a lot of headaches for a lot of business owners. Even though it's very tempting to just take it and use it to fund your marketing campaign or whatever.
Yeah.
It's a very slippery slope once you start doing that.
It really, really is. And I said exactly the same. I do have separate accounts for my businesses that I've got. And we valued up sort of what our quarterly VAT return would likely to be. And we literally review it every month, and we check it on our account system, okay, and are we on track or not? And we put aside every single week what it's going to be. And 99% of the time, when we get to when it's due, we've actually put away too much.
That's a good headache to have.
Yeah, isn't it? So I mean, yeah. So when our bookkeeper says, "Okay, here's your VAT return for the quarter," we're like, "Oh, okay, the 10 grand or whatever, comes back to us."
Yeah.
So it's a really good practice to put. I for one can confirm that it's a really good practice. Yeah. So that's spot on that
I'm glad that you've got it in place.
Yeah.
It's so tempting because you look at the outstanding invoices. And you've got, say, 100 grand or 120 grand of outstanding invoices.
Yeah.
But only 100 of that is your revenue. The additional 20 is the VAT. But the amount of the invoice is 120 and the amount that's going to land in your bank account is 120.
Yeah.
So I can understand why it's so easy to assume that 120 is now ours to use as we wish until we owe it to HMRC.
Yeah,
But
exactly. Yeah, like you say, it's a slippery slope,
yeah.
isn't it? So, I mean, obviously, I've got about like, why do you think that people rely on their bank balance rather than the actual numbers? But I think you probably just explain that. Like, it's like,
Well, yeah, I think there's a bit more to it than that. I think that, so as I mentioned, I think that most business owners are experts at what they do. They're not necessarily numbers people. But if you think about financial statements, the main three, balance sheet, cash flow statement, profit and loss, those were designed by accountants for accountants. And so anyone who wants to understand those things you have to go through a deliberate exercise of actually learning what they're all saying, what the differences are between them. And so if you're not from a finance background, then trying to do that is not always an easy task. So no wonder it's easier to look at your bank account because everyone understands. Look at your bank account, see the cash.
Yes, I see.
So
of course,
I think a lot of it stems from that. If there was an easier way for everyone to actually understand the numbers, avoiding all this jargon speak that accountants like to use, then what is actually, in simple terms, what's going on, then I think the whole game would be a lot easier.
Yeah, you saying that's really true because it's visual. It's, oh, well, I understand what the balance is.
Yeah.
Is it a plus or a negative?
Yeah.
It's simple, isn't it? So I never really looked at it like that, but yeah, that's so true. Yeah, definitely. So, like, what like, obviously you made the switch. So let's say you're really good at numbers. How did you find, or how did you transition to? So I've got like the 7 key areas of a business, sort of like marketing, sales, operations, finance team, and scale, and so on. But so you probably had to, would you say, understand the other areas, or do you outsource that? Like, how did you see that transition? How did you learn it? Or when you went from a corporate to suddenly you've got to stand on your own 2 feet?
Yeah. So it was. There are a lot of people that do what I do. In fractional CFO is kind of the bucket that I fit into. So you can either learn how to do it all yourself, or you can go and work with a larger CFO company who will hopefully give you clients, and then either you work on payroll for them or you take a percentage of the revenue, or whatever way that's going to work. So I decided early on in that process that I wanted to run my business and I wanted to be in control of the whole thing, basically. And that if I wasn't in control of the marketing and the sales and somebody else was, then at any point they could just switch off the lead flow. Or if they had problems with their marketing systems, then I'm the one who's going to suffer from that. And so I decided that whilst it might be tough, I'm going to learn how to do marketing and sales myself. And it, took a while, but I'm doing pretty well. So
yeah, that's brilliant. Yeah. So like, obviously at the moment, what's your thoughts on the general financial situation, vibe, feeling of the whole country, economy, even? Not to get too political, we don't want to dive too deep, but I'm kind of thinking from an SME point of view.
Yeah.
What sort of things might they be feeling at the moment, and perhaps the effect that these external decisions, etc., make on having like a sort of like small business financially?
That's a good question, and it's very topical at the moment. So you've got, I mean, there are a number of things going on in the world at the moment, but if you break it down to what's affecting small businesses the most, I think it comes down to the cost of living and wages going up. So anyone who hires people on minimum wage or close to minimum wage, that's impacting their cost base. You've got AI coming in. So lots of businesses or business models are under threat from AI, which can, in some cases, for example, SaaS, now just do everything a lot faster. Barriers to entry that were previously there are no longer there. You've got the tax situation in the UK with a lot of wealthy people leaving, which essentially is going to mean that everyone else's tax bill goes up to cover it. But I try not to get too bogged down with all of that because you can get yourself into a bit of a negative spiral. And I think that we're still in one of the most developed economies in the world, developed countries in the world. London is still one of the most wealthy cities in the world. And there is opportunity everywhere if you choose to find it. For every small business that's struggling, there is one that's doing tremendously well. And so I think that if you try and focus on finding that and focus on acknowledging that, then you're going to find it. Yeah. As opposed to focusing on how difficult everything is and how, we're making less money than we did last year and costs have gone up and our margins have shrunk and HMRC want more money. Um, that is out of our control as business owners, but the way we choose to see the world isn't. So, yeah,
Yeah, that's very true because it's almost like the environment that you put yourself into,
yeah,
isn't it? Is it a negative or positive one,
yeah,
or sort of like a sit back and wait or a go-getter kind of environment? And I think, like you say, and I don't know the whole facts and figures of it too deeply, but we are in a country, yes, okay, things are changing and some may see it as a negative, but it's almost like an environment that's you can still go out and get.
yeah,
Do you know what I mean? It still is that opportunity there. So I do think it's you try your best not to get bogged down, as you said, with
yeah,
what's going on. Focus only more what you can control. And I agree with you. I do think there's a lot of opportunity still. And it's
yeah,
just a case of, okay, it might be a little bit harder to get that opportunity. Some people might say it's harder to do business now
yeah,
with so many obstacles in, but it's still in an environment or a country, let's say,
yeah,
that you can still do that in.
exactly.
You know, and that's something I think is a positive to take from that. It's just perhaps you have to push a little bit harder, but it's the opportunity is still there.
Exactly. If you put it into perspective, okay, the US is perhaps a bit more entrepreneurial and
Mm.
a bit more pro business. But aside from the US, the UK is still
Mm.
relatively pro business compared to the rest of the world. I mean,
Yeah.
think of the rest of the world. Forget Dubai for a second.
Yeah.
But besides Dubai and the US, where else would you rather start a business? And I don't think there's many you'd put above the UK besides those two others. And
Yeah.
so actually, we can all live and work in the UK. We're incredibly fortunate to be able to live and work in one of the most prosperous countries in the world. And so if we focus on that instead of how, the UK's on long-term managed decline or whatever you want to read and
Mm.
focus on, then I think we're lucky and there's opportunity everywhere.
Yeah. I totally agree. And that's really good that you said that because as I said, there's so much going on, isn't
Yeah.
it? So I think that's a really positive take on it.
And I'm not saying it's not hard. There are
No.
certain industries in particular where things are really hard at the moment.
Mm.
And yeah, there are some industries that, long-term business models are not going to be viable in the way they have been in the past. But still, as a place to do business, that's what I'm trying to get across. It's
Yeah, definitely. And I think in any situation, any economy, in any, I don't know, whatever goes on in the world, there are going to be winners and losers,
yeah,
sort of like fortunate or unfortunate. But then it's almost going back to the numbers, forecasting. You also want to forecast everything else in your business because you can then foresee or you look ahead and you think, okay, that might happen. Let's just perhaps go in a bit leaner or let's just do these adjustments so
yeah,
we can go in a bit better. If it doesn't happen, then great. Like the VAT, put it away
yeah,
every single week or whatever. At the end of the month, at the end of the quarter, you got it all. Or if not, you've got 10 grand left. Well, okay, win-win. But it's like that exact same sort of analogy on everything else. So like you say, there are going to be winners and losers, of course.
yeah,
But I think those that perhaps want to look ahead and say, okay, let me just implement this or change this or perhaps pivot into this area. Like you say with the AI thing, if something happens to a company or a job in or a role in 2 years' time and it's completely gone, it's not as if it's happened all of a sudden. You're like, well, you were told about this 2 years ago.
yeah,
So you should now be thinking like now, what's going to happen in 2 years' time?
yeah,
Not wait for it to happen. And that's kind of goes back to the whole forecasting and you can put it on anything really, can't you?
yeah. I think with the example you gave, some of it is going to be hard to foresee.
Mm.
What's going to happen with AI? I don't think anyone really knows.
No,
Yeah, you can listen
certainly
to
not.
any podcast from any expert. They all say slightly different things.
Yeah.
We don't really know.
Yeah.
But what we can assume is that it is going to disrupt certain roles, certain industries in particular, maybe little bits at a time. And so I personally would rather be on the right side of that than the wrong side of that.
Yeah. Yeah, because you can always see it disrupting some
Yeah,
industries and some roles at the moment already. So you think, well, that's only going to continue.
yeah,
So yeah, you almost want to kind of foresee that, perhaps even implement it as well. So
yeah,
then you're adapting to it, which is always good. So going back to what we can control and what we can't. So what we can control as business owners, we can control what goes out of the business. And I know an element, obviously, there's agreements and so on. So we have to meet those agreements. But if we were to go in a leaner state of mind, what do you think would be a good place to start or some good practices that you can do to kind of let's just start with a P&L. I know that's sort of like one of the
yeah.
basic ways of looking at it, but what would you do if you want to go in a bit leaner? What would you do? What would be the tips that you would give?
So I'll answer your question in a indirect way, then I'll come back to it.
Sure.
So what I like to do is I like to break the businesses up into the key drivers of the business. So every business, doesn't matter whether you're Uber or Amazon or your business or my business, they're made up of exactly the same parts. if you imagine a washing machines are all made of the same parts. So if a washing machine isn't working properly, we go and find the part that isn't working, and then we focus on fixing that part and that part only. We wouldn't bother trying to fix the parts that are working, because that would be madness. Yeah. So because we're not going to get very far.
Exactly.
So it's the same with our business. So we break our business down into the parts, and every month we track the parts to check they're all working. We look at the lights on the front, red, amber, green, and then we find the bits. If any month one isn't working, we find the part that's not working, and we focus on fixing that. And that's what we do with our business. So we break the business up into the parts. There are, depending on how you want to do it, 15 to 20 parts, depending on how much detail you want to go. We can get into that if you want, but let's just start with revenue, gross profit, net profit, cash. I think that's relatively straightforward for anyone to remember. Revenue, gross profit, net profit, cash. Those are the main four.
So did you want to break it down? So revenue.
Yeah. So I'll go into them all.
Yeah. Okay. Go.
So what we want to do. So I'll go into it. Revenue is how much cash you get from your customers.
Yep.
Or how much you invoice your customers. Gross profit is what's left after you take off the direct cost of the sale. So let's take your business, for example, window cleaning.
Yeah.
If you've got a contract with a building maintenance manager for say 100 grand, your revenue is going to be 100 grand. You take off your direct costs of delivering that service, which are variable. So let's say you use subcontractors to do all the work. So you take off 60 because you use subcontractors to come and clean the windows. So you're left with 40. And then after that 40, so that's your gross profit. Then you've got all your overheads, which you can't reduce as work comes in and out. So you've got your office staff. So let's say you've got 10 grand of office staff that, schedule the appointments, issue the invoice, customer service, that kind of thing. You've got 10 grand of other bits and pieces. So insurance, rent, bits of travel, maybe a few vans, that kind of thing. And you're left with 20. So 20 is your net profit.
Okay.
Makes sense so far?
Definitely.
Yeah.
Yep.
So 20 is your net profit. Let's forget about tax for now. Tax comes off that as well, but we'll not deal with that here. Then let's say of that 100 that the customer owes you, they don't pay. Okay, so your profit's going to be 20, but then all of a sudden you don't get paid the 100. So now your cash flow is going to go to minus 80. Sorry. Yeah. So basically your cash flow is
right.
minus 80.
Yeah.
So that's how profit and cash are not the same thing, which is a very frequent question I get. The accountant said we made 200 grand last year in profit, so where's the cash? And the answer is because the difference between net profit and cash, there are a few drivers between them that affect whether you actually receive that cash in your bank account. So you've got number of days outstanding, basically how quickly it takes you to get paid by your clients. So if you issue an invoice on today and it takes you 60 days to get paid, but you've got all of your bills to pay before then that's going to negatively impact your cash flow. Yeah. You've got inventory, number of days that inventory sits on your balance sheet. I don't think that affects your business as like a service business.
Not so much. No, we have very small amounts of that.
So then you've got number of days payable outstanding. So this is essentially how long it takes you to pay your suppliers. So if you're paying your suppliers before you get paid by your clients, then that's going to impact you cash flow wise.
Yeah.
Then you've got additions or reductions in debt. So debt is good if it's used to grow the business. So we like some debt, but we don't like all debt. If we're using debt to cover our operating expenses because we've made a mistake somewhere else in the business, and that can be a bit of a slippery slope, and we can dive into that. And then we've got any increase or decrease in cash due to an investment in the business, so fixed assets, capex.
Right.
So in your case, let's say you need to reinvest in the office to make it nicer so that everyone's happier at work or whatever, then that would be a capital investment back into the business.
Right.
And then you've got owner draws, so your dividends, they don't come off the profit, they come off after that.
Yeah.
So those, then don't worry if you didn't follow it, but I've got a PDF that I can give you, which breaks down the difference between profit and cash and shows you all the other drivers.
Okay, brilliant. I'll share that with anyone that wants it. Yeah. Okay, brilliant.
Yeah. But that's a very frequent question that I get, is that profit and cash are not the same thing, or we made this much profit, where is it?
Yeah, and that's very true, because it's kind of like with that breakdown, it's like or I don't know, perhaps you would say, is like then you look at what can you control and what can't you, in a sense of the administrative costs, like after the gross profit. like perhaps could you go out and like we do with our household bills, isn't it? Or can we get a better energy bill this month and so on? So that sort of thing. It's doing the exact same exercise, isn't it, with your
Yeah.
business?
Yeah, exactly. So yeah, back to your question, which is how can we be more lean?
Yeah.
I would break the business up into those parts, so revenue, gross profit, net profit, cash, and then I would look at the individual numbers themselves. Ideally, we want to set targets for each part of the business. So we want to target for revenue, target for gross profit, target for net profit, and a target for cash.
Yeah.
And then I would compare the target to the actual number. So if your business, the target gross profit margin is say 40%, but you're at 35, that would be the thing that we focus on improving.
Ah, yes, that's a good way.
And
Yeah,
so
yeah.
you can go. I would definitely recommend going through the exercise that you just touched on. So we look at the actual expense line items, so every single line: insurance, rent, utilities, vans, everything. Can we get a better deal? Yes, that's a good exercise to do. But it's also good to actually make sure that we're focused on the right area of the business in the first place, because you can only cut your way to so much growth, or you can't cut your way to growth.
Yeah.
So you can cut your way and you'll improve your margins, great. And we do want to make sure that our margins are optimized before we then focus on revenue growth. But there's only a limit to how far that can go.
Yeah, that's very true, because it's almost like if you try and if you keep cutting, sometimes you're cutting something that was very, very valuable, that was actually a major part of generating that top line.
Yeah.
So like you say, you can't just keep cutting. You do have to focus on the actual growth and delivering the service. So then you do grow off of the back of that,
Yeah.
you know.
But like I said, it's important to track the numbers versus a target, because for example, if you're doing 10 million in revenue and you're doing 1% profit margins, then focusing your attention on generating more revenue with 1% profit margins is not really, you're going to do a lot of extra work for 1% profit margins, and that's a lot of work for not much more money.
Yeah.
So if you focus on, in that case, on the margins, it could be a gross profit problem or it could be a net profit problem. Get that profit margin to where it needs to be for the industry, let's say construction 10%.
Yeah.
Get that margin back up to 10% and then focus on the revenue.
It's good you touched on that, actually, because I found that different industries have different markers, don't they? So is it really like detailed, like you said, like construction? Might that be something different to a service-based business, or perhaps a product producing business? Like, because like even like the shopping markets, I think they're like 3 to 4%. Apparently, if they get like, when you hear like Marks and Spencer's turn 2.5% profit, you're like, Jesus, hardly worth it. And then you see the number, you're like, okay, well, that's worth it. But it's almost like that's actually good for their industry.
Yeah.
Is that very true? Like in that sort of thing, does an industry have a bit of a standard to go by as a guide? Like if you're in construction, or like you say, a service-based business, then your gross profit and net profit should be around about this kind of, give or take a couple of percent.
Yes, it does work like that. So
Right.
in construction, for example, construction is typically lower than other industries, and there's a few reasons for that. But one of them is that with construction, the materials cost is included in the revenue, so that compresses the margin essentially.
Yeah. Just on that, there's quite a few external factors that can affect that, isn't there? Like, with all this material and stuff going up, but like that's all of a sudden your pricing market has gone out the window, isn't it? You have to really evaluate everything each time, because it goes up and down all of the time, doesn't it?
Construction's really tough because you've not only got the price pressure, there's a lot of competition, so everyone's competing on price. So your price is as low as it can be anyway. And then you've got the cost of the underlying materials changing, going up. You've got labor going up at the same time. Then you've got the cash flow problem. So when you start a project in construction, you're going to have to pay, as the construction company, the upfront labor and materials costs. And then you're going to have to wait 30 to 60, sometimes even longer, days before you get paid your first installment by your client. So you're funding that. You're the bank.
Yeah, so that's why the cash flow comes. It's so important, isn't it, to keep an eye on that and make sure that you've got a good, sturdy cash flow system in place.
Yeah.
So with the pricing then, what's your views on sort of like price cutting and price wars even? Like, how would you oversee it? I know that it's probably like a business like strategy on a whole.
Yeah.
Obviously, it comes down to numbers, but what would you think is because there's so much of it, isn't there? I find certainly recently, everyone's talking about like cheaper, because they don't mean to. It's just that everything else is so much external pressure, isn't there? So you do have to go for sometimes a cheaper option. And then if you, like you just touched on there, like if you do have to price cut, what's the dangers, or is there a strategy to have that you can probably protect yourself? Like, what do you think on all of that?
So I think the key is pricing it out so that you can see how much money you're going to make on any given project. And you've got to have a walk away point, because I see it particularly with construction where the margins are so thin that, 3 or 4% margin on a project, that you're carrying so much risk going into that project. If something goes wrong and things escalate and you're not able to pass any increase in cost to your clients, then you're going to have to carry that loss. So one of my clients that I started working with about 6 months ago, when I started working with them the previous year, we looked at the numbers for the previous year, and what we found was that overall for the year they did a 2% profit margin, 2% on 10 million revenue.
Oh, wow.
And the cause of that, and I sort of asked the business owner what's happened here, and initially he didn't know. So we had to go into a bit more detail, and this is very common. Very often they don't really know what's caused it. So we go into more detail, and we find that actually of the 5 projects that they did, or maybe it's 7 projects or whatever it was that they did, they made a healthy profit margin, 10%. But there was one project that just went completely off target, and that pulled all of the profit out of all the other projects for the whole business.
Just one project out of 7.
Yeah. So I think, and on that particular one, there were a few things that went wrong. It was the pricing to start with, because they really wanted to win the project. And then there were costs that they couldn't pass on to their client. So you have to have a walk away, to your question. In terms of pricing, you have to have a walk away point. You have to be very clear that if a project isn't hitting your profit margin target, then you've got to have a very good reason why you should do that project. And be well aware of the risk that you're carrying if you decide to do it.
Yeah, that's a really good point, that actually, because we done something at the beginning of the year in light of obviously this new increase. Well, it happened last April, but the increase of the PAYE, etc. And it was like, okay, right, because we do everything in mandates. So, I mean, how many men is it going to take to complete this job?
Yeah.
And I would imagine the construction is kind of exactly the same. Plus materials for them. It's huge, isn't it, the materials? But we kind of looked at, like, okay, because we employ everyone. So it's like, okay, national insurance, employee contribution, and of course the overall insurance, and then we done fuels for the vans, the wear and tear, etc. And then what we done was we broke it down, all of the direct costs, broke it all down into what is our break-even points. But we factored in everything, even the annual leave. Like, what's one person costing us in the year? And that's kind of what we done. So we broke it down into what is our break-even points. So that's when we come up with the mandates. Okay, right, that's our budget. So if it's 10 mandates, we're already at our break-even points. It has to be that, or we walk away, as you say.
Yeah.
But I'm finding it increasingly, or the pressure's is increasing because of everything that's going on. So whereas before it used to be customer experience, value added, etc., or perceived value and so on, but even more so, certainly this year, it seems to be a little bit more pressured on the numbers. And do you think it's because of the external pressure that's kind of going on?
I think everyone's a bit more price sensitive. Everyone's costs have gone up, and so everyone is having to focus a bit more on how much is going out. So yeah, I do think that is happening, particularly in construction and trade businesses.
Yeah, that's a really good tip. That's you sort of like you say, your walk away kind of figure. That's there was an old thing, wasn't there, years ago? It was like, before, a great deal maker would be a person that's already got his bottom line, or what he wants to walk away from, before the meeting has already started. So it's exactly that, isn't it? It's like, what's your break-even point? Do not go below that break-even point, because in your story, they had like 7 contracts that done so well, and one that literally just damaged all of their hard work on the 7.
Yeah.
That is just crazy at 10 million as well.
Yeah, and there were reasons they took it. They did it because it was going to be good for future case studies, but it ended up completely wiping out 90% of the profits for the whole business. So
that is crazy, isn't it? So let's say, like you've got, like you said, correct me if I'm wrong, I thought it was like profit and loss is sort of like the first part, then cash flow, then balance sheet. So let's say, for instance, I'm a business owner and I'm reviewing those 3.
Yeah.
What sort of things should I, well, 1, is that right? And 2, what sort of things should I be looking at, and how important is it to review all 3?
Yeah. So I would say if you're not familiar with the 3 financial statements and how they work, then I think it's beneficial for any business owner to learn how they work. Okay. If you're not, for now, you can just get started with tracking revenue, gross profit, net profit, and cash. If nothing else, just start with that. Getting a simple 3-month cash flow forecast in place as well. I've got templates that I give away for free on my LinkedIn. So go on there, download, should be pretty easy to use.
Brilliant.
If you are familiar or want to get familiar with the 3 financial statements, then using them all together is kind of the way to do it. So profit and loss shows you how much money you receive from your clients or how much you're invoicing your clients. So revenue at the top, taking off all your expenses and ending up with your net profit at the bottom. So that's how much you made in a given period. Let's say the last financial year, that'll show you how much you made in that financial year. Okay, so that's one.
Yep.
Second one is the balance sheet. So the balance sheet is basically a snapshot of the net asset position of the business at any given point in time. So it's basically showing you the net worth of the business at any given point in time. So you've got all of your assets, which are the things that you own. You've got your liabilities, which is what you owe to other people. And then you've got your equity, which is what's left. So your assets minus your liabilities. So if you apply the same thing to your personal net worth, you've got your assets, which is the things that you own. So you've got your cash and you've got your house. And then you've got your liabilities, which is your mortgage and maybe your car if you've got a car finance thing. And then you've got whatever's left, which is your assets minus your liabilities. And that's all a balance sheet is for a business. It's not more complicated than that.
So I didn't really value the value of a balance sheet, or certainly the figures, until about 2.5 years ago, when I had a financial manager come in and sort it all out for me, and now she works for me full time. But before then, I used to think, well, like yourself, well, my P&L looks good, and there's some cash in the bank, and I'm having a good life, no problem. But then you get to the point where you really want to scale, and either you need investors or you need a loan or something like that to scale. And the first thing they look at is what?
Balance sheet.
There you go. So yeah. I didn't realise that until, I said, a couple of years ago, when I wanted to do a bit of merger and acquisitions to some companies, and the banks looked at it and pretty much said, no chance. So I was like, okay, well, I want like 500,000 to buy these companies, and well, absolutely no chance of we doing that. Just on paper. First hurdle, collapsed straight away. And then all of a sudden I thought, well, okay, well, tell me, what do I need? And they said about the balance sheet, and they told me all about reviewing this and how to make it a bit more healthier. And now literally we've got like loads of options, all because of cleaning up the balance sheet.
Yeah.
So the value of it is incredible, isn't it? So if you want, some people might say, do you know what? I like my business the way it is. I'm good. Okay, that's fine. But if ever you were to have a different mindset and you think, do you know what, I want to scale and I want to really expand, you may need some money or some investment at some point. And the first thing that any financial person is going to do is look at the balance sheet.
Yeah.
So there's a bit of a like forecasting way of looking at your goals in the next 12 to 18 months. Look at ways on how you can increase that, or certainly make it more valuable to someone that's reviewing it, isn't it?
Yeah. Yeah. So a good bookkeeper should be able to keep the balance sheet in good shape. Right. So a good bookkeeper will be able to keep your books in shape so that you can pull the profit and loss, you can pull the balance sheet, or you can pull the cash flow statement at any given point in time, or at least at the end of any month once they've done the previous month's books, and it'll be in decent shape. So a good bookkeeper is what every business should have.
So you mentioned about you've got a couple of PDFs and stuff that you can give away. Is there anything that you can kind of give away on, or sort of like send people to, like some of your material about reviewing these sort of like 3 statements? Yes. On my LinkedIn, if you scroll through my LinkedIn post, there's a good number of how to read a balance sheet, how to read a profit and loss, how to read a cash flow statement. Brilliant. Okay, I'll add that in the link at the bottom.
But the other one that we haven't touched on is the cash flow statement. So the cash flow statement is basically, it ties up between the two, the difference between profit and the actual cash that's come in or out of the business. And the cash flow statement explains it. So it says, essentially, your starting balance was this, your ending balance was this, and this is what happened in between. So the business made X amount of profit, but this amount of money did or didn't flow into the business to get us to the ending cash flow. And so that's what a cash flow statement does. Yeah, the cash flow statement was one that I sort of struggled with in a sense, but only because I couldn't understand like you said, you see the P&L and so on. But I think when you understand all 3, it's very, very valuable to then make the decisions off of the back of those. But so the cash flow one, what about if you've got, you've got these invoice discounting, or you've got invoice factoring, all these different things. Yeah. How would you play that? Like, let's say if some companies have got that, how would you does that affect the cash flow statement in some ways? Well, the invoice facilities can work in slightly different ways, but I think the most important thing that we understand is the cash coming actually in and out of the bank account. So the way a lot of invoice facilities will work is that when you issue an invoice to a customer, you get paid that money straight away from the invoice facility provider. And then essentially, instead of having to wait 30 or 60 days to collect that invoice, the cash from your customer, you've got it straight away from the invoice facility. So that's kind of how that would work. And then that would show up on the financial statements because you would have collected that cash sooner. But then you're still going to have to, pay the fees and charges associated with the factoring facility.
Yeah, 'cause I think that's the value of looking at all of the reports. It's because you can look at what you're actually owed. Let's say you owe like £1 million, and you think, well, I've already had like, let's say 70 or 80% of that already.
Yeah.
So it's not as if you've got £1 million sitting, when that comes in, that's it, I can retire. No, you've already had 700-800 grand of that already.
Yeah.
And out of that, of course, you've got to pay your liabilities like your VAT and your corp tax, etc. But I wondered if the cash flow, like, is there a way of sort of like incorporating that into the cash flow statement?
Incorporating what? Sorry.
Like the fact that you've already had all that come forward, so you don't really want to make a decision based on, okay, you owed £1 million, but you've already had, let's say, 700,000 or 800,000 pounds of it
Through the
already.
invoice facility.
Yes. Yeah.
So yeah,
I wonder if it changes a little bit on these reports.
Yes. So I would. I think I understand what you're asking. I would just keep it quite simple. So if you've got an invoice outstanding to a customer, but you've already received that cash from the factoring facility, then you can mark, assuming you're getting 70% of it, you can mark 70% of it as essentially having been paid.
Right.
So you're only then owed, what's remaining.
Yeah, that's a good little trick, actually. Yeah, definitely.
The key is to not overcomplicate any of this, because as soon as it gets complicated, whatever that means for whoever is listening or whoever wants to start doing some of this, as soon as it gets complicated, it ends up being too much of a burden to do, and then it gets left undone. So the key is to just keep it as simple as possible, and that's why I always start with tracking revenue, gross profit, net profit, cash, set targets for each one, and then track them versus the target every month, and then have that 3-month cash flow forecast in place. And literally all you're tracking is how much cash is going to come in or out of the bank account. And we're just trying to see, are we okay for the next 3 months? That's basically all we're trying to see. Yeah. Rather than us getting to 2 months down the line and realizing actually we're in big trouble, we didn't know this was going to happen.
Yeah, definitely. Yeah, I like that, the 4 points as well, because like you said, the moment it has a bit of resistance to it, you're less likely to keep up with it or do it regularly. Yeah, of course. Yeah, exactly. Yeah. So what do you think would be one habit or an approach to forecasting then? Was there like little tips that you kind of do, like the 4 steps you said to review? Is there anything like that for forecasting at all?
I would start with exactly those same 4 points.
Okay.
So you'd start with, let's say you're setting a forecast. Forecast and budget are 2 different things. So forecast is how much you actually think is going to land over whatever period you're forecasting for. This is what you actually think is going to happen. A budget is your target. Okay.
Right. Okay, that's interesting.
Yeah. So target and budget can be used interchangeably, but a forecast is where you're actually going most likely to happen. So then you can compare your forecast versus your target.
Gotcha. Okay.
Yeah. So start with revenue, then goes to gross profit. So we've got a revenue target for the next year, let's say. Is that going to be split out evenly across the months, or is it going to be higher in the summer, lower in the winter? It just depends on the business. So we're gonna set out 12 rows along the top, how much we're going to do in revenue each month. This is you can budget or forecast, whichever one you want to start with. And then we're going to go for a gross profit target. So let's say 40% gross profit target. So 60% is going to come off our revenue to give us our 40% gross profit. And then we've got all of our other expenses down below. And you can break down your gross profit into the exact line items that are going to come out. So you've got, let's say, labor, materials, maybe some transaction fees, whatever else might be in there. Put that in there. And then you've got your overheads. So how many people have you got in the office staff? How much rent are you paying? Insurance, vans, fuel, whatever else comes out down below. And that becomes your starting point for the year. And then every month, all you're going to do is you're going to go in there and you're going to compare. You're going to write in the actual number and then compare the actual number to what you targeted, your budget.
Yeah.
And then you're going to have a conversation with yourself or with your team or whoever is responsible for delivering that number. What happened? Are we on track? Are we off track? If we're off track, what do we need to do to get back on track? And so for this part, I use a simple scoreboard with my clients and with my business. So red, amber, green across the whole business.
Okay.
So each one of those areas, revenue, gross profit, net profit, cash, red, amber, green. And then that helps us identify where we need to focus our attention on improving things over the next 30 days. Doesn't mean that if we're way off our revenue target, we're magically going to fix it. But if we consistently focus our attention on the right things, then we're going to do the best we can at getting the business back on track or staying on track to achieving our targets. So that's
Yeah.
kind of the framework that I use. So take an example in a bit more detail. Let's say 1 month you do 35% gross profit margins, but your target's 40. Okay, that becomes the area of focus. Revenue's on track, the net profit margin's off track, but your gross profit being off track has caused that. Cash is fine. We're collecting the cash from our clients. We're not in debt. We're good. So gross profit becomes the area that we're going to focus on. We're going to mark that as red. So we have a conversation with the team. These are the things that are making up our gross profit. Our revenue is our pricing where it needs to be. Are the clients that we want to work with? And then the individual line items that come off as cost of sales. So transaction costs, materials, labor, anything else that's a variable cost in there. What can we do to improve that gross profit number from 35 to 40%? And if you can't come up with anything yourself, then ask your team.
Yeah.
Because they're a bit closer to detail than you are, so they might be able to come up with some ideas that you can't. And essentially, it's about being more efficient. It's not necessarily about cutting, but maybe sometimes it is, but it's about being more efficient. How do we convert more of that revenue into profit?
Yeah, sort of like producing those results, isn't it? And like you say, if some of the guys on site are, let's say, not putting their weight in some areas, you think, okay, go and have a word with them. Perhaps, ask if they can do a little bit more. And that, for the same money you're spending for that person, you're now all of a sudden getting a bit more, in your gross profit, as you say.
Yeah, and very often, well, sometimes the business owners kind of scratch their heads when I would ask them, how can you improve that number? They're like, well, we're already as efficient as we can be. I'm like, well, if we take a step back, your gross profit is 35%, but your competitors are doing 40. So I know you can't come up with any ideas, but there is a reason that you're doing 35 and not 40. Or in a construction example, your net profit margin was 2%. Your competitors, the ones that are doing a good job, are doing 10. So what are they doing that you're not? So instead of coming up with a blank piece of paper and not being able to come up with any ideas, let's think outside the box. What are they doing that you're not?
Yeah, that's a really good way of actually asking that.
And I think we don't need to completely reinvent the wheel. You've got the business to a point where it's already doing really well. You've got clients are happy. You've got repeat customers. The team's all happy. They're staying, they've been working for you for a while. We don't need to reinvent the wheel entirely and rip everything up and start again. It's finding sometimes 1% tweaks here and there. So, for example, if you're a facilities management company, how can you get more billable hours in a day? Well, with one of my clients, we found that they were actually spending a lot of the time driving, almost up to 50% of the day. So that's 50% of their time they're not billing for. So if we can get the people responsible for scheduling the drivers, the engineers, to actually be a bit more thoughtful about where they were putting these appointments and making driving routes much more efficient, and even if that meant that customers had to wait a day or two before they get seen, then we could probably end up billing a lot more. So small things like that.
That's right, like geographically and stuff, isn't it? Because obviously it's a lot less labour, it's less fuel, etc. That's a really good little trick. Yeah, definitely. I mean, it's funny you mentioned something like about like when you look at what the competitors are doing, or perhaps the industry is saying that you should be doing. Some people overcomplicate business, or not some, a lot of people.
Yeah.
And there's a guy that I follow, and I used to be part of his coaching thing years ago before COVID hit. Brad Sugars. Do you know Brad Sugars?
Yeah.
Of Action Coach. So I went along, there was a couple of years that I went, he'd done a course in Kensington. There's only about 20 people in this room. He'd done it every September, and I went along to both of them. And the way he simplifies business, because he buys many, many businesses in so many, like most random industries. And all he says is he's got the 5 ways model, hasn't he? And he implements his 5 ways model, puts it on every single business, and he buys it, does more profit after implementing his systems and his 5 ways, and then sells it and makes a profit out of it.
Yeah.
But he has like a cleaning business, like an accountant business, like and loads of others. But it's just it's the same model. And he said you don't have to overcomplicate. Business is business. No matter what industry you're in, it's still business. Focus on these 5 areas, I guarantee you'll do pretty well on it. And it is exactly like you said, like, what's the industry doing? That's a good question. Like, well, why are they doing it then and you're not? And you're in the same industry, Don't overcomplicate things. I think many people make that mistake, don't they?
Yeah. And I
think like it's only them. Oh, well, it's only my business. No one understands it. You think, well, it's still a business,
Exactly. And I think going back to the point that we mentioned earlier around how things are tough in the economy, and instead of getting into the negative spiral of things are so tough, my business isn't working, this industry doesn't work anymore. Actually, let's find some businesses that are doing well and that are hitting their targets essentially. What are they doing that we're not? Think of it like that. I think it changes the ideas that you come up with.
Yeah, definitely. Even in the same industry. You don't even
Absolutely,
have
in
to.
the same industry.
Yeah,
That's
yeah.
what I mean. Yeah,
That's it. Yeah.
yeah. So if you're a
Brilliant.
construction business doing 2% margins, and you know that there are others out there doing 10, instead of thinking this industry is so hard, this market doesn't work anymore, the UK is broken. Actually, those businesses over there are doing 10%. So what are they doing that we're not? Let's work out what it is, and then do that.
Brilliant.
Yeah.
Yeah. So we've got a quick fire round, just 3 questions. So what numbers should every business owner be looking at on a weekly basis?
Weekly basis. Cash flow.
Cash flow.
Cash flow. How much cash is in the bank? Just look at that. How much cash is in the bank? And if you can update a 13-week cash flow forecast on a weekly basis, then that would be ideal.
Brilliant. Okay. What's the biggest financial mistake that you see business owners making time and again?
Well, I've already said making decisions based on gut. So I'm not, or based on how much money is in the bank. So I'm not going to say it again. The other thing is thinking their accountant's going to help them, which we haven't actually talked about. So very often business owners will ask me, following a conversation that I have with them, why isn't my accountant helping me with what you're helping me with, or following the stuff that you talk about on your LinkedIn, for example. And the answer is that very often your accountant's doing a perfectly adequate job of helping you file your accounts and telling you how much corporation tax you have to pay and filing your VAT returns. But that is their job. You're not paying them to give you support on how to run your business from a financial perspective, or forward-looking strategy, or pricing decisions, cash flow decisions, that kind of thing. That falls outside the scope of the vast majority of accountants. And so that is why your accountant's not helping you. Yeah.
I think that's a mistake that sort of like many people do. They think, okay, I've got an accountant. That's it, done. That's all. That's as far as I need to go.
Yeah, that's the financial part taken care of.
Yeah, exactly. Yeah, but as you've touched on here, like you've got so many other areas, and once mentioned accountant.
Yeah.
There's so many other areas before we even mentioned accountant. So it's crazy. So I think we probably already answered this, but let's give it a go again. So what's one simple change that a business could make to improve its cash flow?
So to improve its cash flow, okay, so we talked about tracking cash flow. So that's step number 1. To improve the cash flow, you've got to look at essentially everything coming in and everything going out. So if we look at the drivers between profit and cash, those are your cash flow drivers. So the drivers of cash flow are firstly net profit. So the way we can improve our cash flows to make more profit. Okay, that's 1. Number 2 is to take a bit longer to pay our suppliers. Number 3 is to collect our cash from our customers faster. That's probably the lowest hanging fruit for most business owners, to collect cash from their clients faster. It's to take on debt, because remember, cash flow is the difference between the amount that you started with and the amount you ended with. So if your cash is going to come into your business, that's an improvement in cash flow. So taking on more debt means cash comes into the business. That doesn't necessarily mean we should take on debt all the time, but debt can improve cash flow. Business owner paying themselves less through dividends. So if a business owner is paying themselves through dividends, it comes out after the profit line. So if business owner pays themselves less or fewer dividends, then that is going to improve the cash flow of the business. We want the business owner to get paid lots of money, so that's not always the right thing to do, but it improves the cash flow of the business. And then looking at what you're reinvesting back into the business in terms of capital expenditure, potentially reducing that will improve the cash flow of the business.
Yeah, brilliant. And I think
I'm not saying those are the things you should do, but those are the things that will improve the cash flow of the business, if that's something that needs to be done.
Yeah.
You need to look at every case individually and work out what the best decision is for the given situation.
Exactly. It's like your traffic light system, sort of like a red, amber, green. It's like, okay, let's have a look at these points that you've just made. Where might be a good place for us to do, or where perhaps might be a red area or even an amber area, So, there's a great. And then finally, where can people find you? Where can they best get in touch and get some of this material that sort of you're giving away at the moment?
Yeah. So best place is LinkedIn. So Tom Griffiths CFO. Tom Griffiths CFO. I post about finance stuff pretty much every day. So I've got lots of PDFs and things that I post about. You can either download them straight from my posts, or you can message me and I'll send them over. I've also got a few giveaways. So for example, the drivers that I've talked about, revenue, gross profit, net profit, cash, and then going into a bit more detail about what drives revenue, what drives gross profit, what drives net profit, and what drives cash. I've got a PDF that explains that pretty clearly. And then I've also got a free cash flow forecast that anyone can just download and implement. And I've tried every piece of software out there in terms of trying to track cash flow better. And what I've always arrive at with small business owners is that if you have poor data going in, you're going to have poor data going out. So it doesn't matter what software you're using. If the data going into it isn't perfect, then the stuff you get out is not going to be perfect either. So simple Excel spreadsheet or Google Sheets once a week. Go in there, look at what's coming in and out of the bank over the next few weeks or months, type in the current bank balance, and then that'll give you an idea of where things are heading and how you're doing.
Brilliant. Yeah, thank you very much, Tom. I'll put your LinkedIn profile in the description of the podcast because I've seen some of the stuff you give away. It's really, really helpful. So thank you very much for doing that. I'll do that. But thank you very much again, Tom. I really enjoyed that.
Thank you for having me, Brad. Pleasure to be here. And yeah, looking forward to speaking to you soon.
Brilliant. Thank you.